yes, the Bitcoin ETFs are up there in terms of some of the most popular ETFs, but we still see more flows into Bitcoin directly. Generally speaking, I think the ETF is very good for the industry. It is a sign of maturity. It's a sign of that crypto as an asset class can mature. Having that layer around part of the crypto ecosystem, I think is a very good thing for the crypto ecosystem itself as well.
All right, guys, bang, bang. I thought a great place to start this conversation would be around the changes in investing trends, right? Public.com is a very large business today. You've got a huge user base. The way they act today is very different than maybe investors were acting 5 years ago. What are some of those trends that you're seeing that have really allowed you to build such a big business?
Yeah, I think what you've seen in the last, call it 5 years, is that real-time investors have really gone through a lot of different market cycles. And because people are really learning by doing, they had a lot of learning experiences that usually take maybe a decade or a few decades to really go through, right? But if we really look back, we launched in September of 2019, to be precise. And at that point in time, you had, 2-something% interest rates, markets were doing its thing. And then literally, 5 months later, you had the COVID drop and the circuit breaker hits in the stock market multiple times within a day, something that hasn't happened in, call it 100 years or so, right? And so that obviously was like one massive kind of learning moment. And obviously that drove, a lot of retail into the market. They saw it as like an opportunity to kind of, buy the bottom, which a lot of them did, as we've seen in our numbers. And then obviously throughout COVID, right, stock market was the only arena that was open. Sports were off. People wanted to have some teams to be rallying behind. Those became, stocks and companies. That drove a lot of volume, of course, and just people being alone at home and stuff. And then suddenly, you have interest rate changes happening. And like each of these cycles has, I think, asset classes attached to them. And if you look throughout COVID, you had your COVID stocks, right? You had, your, travel speculation, you had work from home theme, healthcare, things like that. Then suddenly, in 2022, you went into a market where, people were suddenly looking at, crypto rallies and things like that. 2021, I mean, sorry. And then 2022, things were kind of like rejiggering. People were flying back to things that felt more value again. And that all happened within like 3 years, Interest rates started to rise again. And suddenly things like bonds became interesting, right? Like US Treasuries, like the 6 months T-bill was the number one investment on the app last year for us. Like the number one asset, which is something that was unheard of because bonds were pretty much, like non-existent for a decade plus. And so I think seeing all this happening in such a compressed time frame was quite unprecedented. And so people that entered the markets before like 2019 and that went through all that learning period have really changed their behavior literally on an annual basis. And that's really what we've seen. Like we've seen people that started out on like a Shiba Inu coin and now put, serious money into US Treasuries, which is like two extreme ends of the spectrum, right? So
now, what do you think is driving that change, right? It's very fascinating. If somebody could buy kind of the meme coin and then they can go buy US Treasuries, did they get smarter? Did they learn, kind of more knowledge about the legacy financial world? Did they understand what they were doing when they were buying the meme coin? It was just like, loose monetary policy and meme coins go up, or what was really happening?
I think, again, people learn by doing, and I think people learned by seeing what's happening as they are involved. I often say that investing is a forcing function for financial literacy, where if you have skin in the game, you will care. As you care, you will automatically be more attentive and educate yourself and read the news more properly and things like that. And so I think people being invested, I think, is just generally a very good thing for society as a whole, because people are just get more involved in things they might have not been involved in otherwise, because they have skin in the game. And I think what happened within crypto specifically was crypto was the first asset class that was born retail. So the first people that got rich on crypto were regular people. It was not the big hedge fund managers or anything. It was regular people. And that is a story that is obviously something that is a pretty attractive story to people. And then the other end, you had, I think, a lot of a lot of crypto had was just a lot of community that was built around it because of that. And so, people people want to be part of something. The same reason why you support a sports team and go to the game and hang out with your friends to have something to talk about. I think that same happens in communities around anything else. And, that anything else can also be a cryptocurrency, for example. And I think that's what you've seen with also, especially these like community-driven coins like, Shiba and Doge and whatnot, where people know pretty well that there's, no underlying function in that really than the thing itself, kind of like a piece of art, to be honest, and so from that point on, I think, people like that brought people into the markets. And then as they entered the markets, that's when they started to educate themselves around, how does yield really work? What are the market structures? When something goes up, why does it go up? Et cetera, et cetera. And then that brings them into other asset classes like stocks. And then that brings them into other asset classes like, bonds and treasuries suddenly and so on. But I think the question is like, what pulls them into the market in the first place? And what is an initiating kind of driver? And I think what you've seen in specifically 2020 and 2021 was that crypto was for many people the initiating driver. There was the entry into the markets as a whole, not just the crypto markets.
So how do you think about something like the Bitcoin ETF, which, some people would argue is going to pull interest away from the actual cryptocurrencies themselves? And now people can just go buy this stock that gives you exposure to Bitcoin. And maybe it's the industry itself is maturing a little bit and kind of becoming more sophisticated as well. But do you expect capital flows to change? Or no, the people who would use public or kind of some of these other brokerages, like they are very much, they want to own the coins. They want to have direct exposure. And the Bitcoin ETF is more for like Wall Street investors.
Yeah, and this is exactly what we're seeing. Like what we've seen so far is that, yes, the Bitcoin ETFs are up there in terms of some of the most popular ETFs, as like so far at least. And but we still see more flows into Bitcoin directly, into the actual Bitcoin cryptocurrency. And it's interesting. I don't know if I can like describe exactly the thinking there. Maybe it's just also people getting kind of into it, and maybe they just want to add to positions that are already there and things like that. Because there's an obvious price difference between going directly into the cryptocurrency versus, investing into the ETF. I guess, let's be honest, the ETF is much cheaper. But what we've seen so far is really a different behavior there. Generally speaking, I think the ETF is very good for the industry. And to your point, I think it is a sign of maturity. It's a sign of that, crypto as an asset class can mature, and so on. And, when I talked about this the other day, I kind of, got a few comments of like, oh, something like the government regulating crypto, like that kind of goes against it. I personally think, there's a few things. I think there's a difference between crypto, the asset class, and, blockchain, call it like, a ledger as a function for potentially being used as a financial system in some regards. And that those two are just very separate things. And, one's a technology we can use for many things we might want to build, but the other one, like the coin itself can be an asset class by itself. And the ETF just kind of carves out that function of it and puts it into more markets and makes it more accessible to more, people and brokers and all that kind of stuff. And so for that aspect, right, I would say it's very, very good that there's also something that has a little bit of oversight, that is more regulated, because I personally think that, like the financial markets have matured over, 100 plus years in the world. And, humans did a lot of learnings, and, it can be easily, like, I think it's too simple to just be very binary and be like regulation is good or bad. It depends on what the regulation is. And there's a lot of things that, I think are baked into the financial markets that are quite good to also protect investors and so on. And having that layer around part of the crypto ecosystem, I think is a very good thing for the crypto ecosystem itself as well.
What's fascinating in talking with you is already in just a few minutes, we've talked about ETFs, we've talked about meme coins, we've talked about treasuries, we've talked about value investing, we've talked about Bitcoin, et cetera, right? Like you all have this like bird's eye view. And now it seems like the product that you've built has become this multi-asset platform where people can do everything from options to crypto to traditional stock investing to bonds, et cetera. Talk a little bit about maybe the philosophy of like, what is the product ultimately that you're trying to build? And like, how do you measure success? This episode is brought to you by Bet Online. Do you like making a profit from sports betting? Well, set yourself up to take home the most profit possible using crypto to fund your sports betting, casino, and poker account at betonline.ag. You can avoid costly transaction fees, get your payouts lightning fast, and do it all securely and anonymously with the highest deposit and withdrawal limits in the industry. If you want to get in on the action, do it the smart way with crypto at betonline.ag. Head to the website, sign up with promo code POMP100 to get a 100% bonus on your crypto deposit today. If you go and you deposit, they'll give you 100% bonus if you use promo code POMP100. Bet online. The game starts here. BetOnline.ag. Go check them out today.
Yeah, and so how we think about internally is from our business goal perspective, we want to be people's primary account. And then for the user, I think that means is that we very much believe that if you can manage all your assets in one place, you will end up likely making better investing decisions because you can move money around different asset classes and different investing strategies within the same place. And that holistic view that you can have yourself over your assets and your money will just make it easier for you to have, a better understanding of it and, potentially make smarter decisions for yourself. And, that falls into things like we've done a lot of work to build, we call it internally the holding system. It's like basically like the tech layer that sits on top of everything. There's like a real-time, ledger basically, which enables, real-time money movements between all these asset classes. And that means, I can, sell a UST bill right now and move that money directly into a cryptocurrency a few seconds later. And like that type of, technology, so to say, like the ability to move money around between different asset classes and that kind of speed and so on, and just having that kind of, direct overview of everything, I think can be just very powerful for people's, portfolio management, if lack of better wording, but just like how they manage their money in general.
When you see kind of this management idea, legacy investors, the wealth transfer that's supposedly coming that everyone keeps talking about for the last decade, they had financial advisors. They had, I give it to someone else and I kind of like forget about it to a degree. Maybe I meet with them twice a year, but that person, they've got it. They're going to figure it out. They're going to go allocate 60-40, global portfolio and really kind of go with the academic theory. Or the people who are using public, talking to a financial advisor, is that kind of getting kicked out of the industry or are you kind of a workaround? How do you look at the technology versus maybe the human side or the advisor side of a business like this?
Yeah, I think the spectrum was historically always thought about just as either it's active or passive, and passive often meaning it's being managed. In theory, if you have your money into like in an ETF, it's managed within that fund, right? So there's a big part of it that's already, so to say. The way we think about it is that it's not that binary, and it's way more nuanced, and that spectrum is much wider. And so internally, we even talk about things like there's guided investing, there's automated investing before something is even managed, right? And in that world, I think, folks are not either or. You want to have the ability to, do a speculative options trade one day, potentially even just because you think it's fun or whatever, and at the same time, you want to have, money in the NASDAQ ETF and just let it sit and, compound over decades. And I think that duality exists for most people, really. And the other side of it, I think, is also, I think a lot of people, and that's what we're seeing, obviously, because we're also an active platform, as a default, but is that people do want to have some control over it themselves. And that doesn't mean that part of the portfolio might not could be managed. Back to even an ETF technically is managed in some regards. But it just means that, people like the sense of that they have control. And I think this notion of you completely give it to someone to manage and just like don't look at it and move away, I think is going to go away more and more, especially also because what we've seen specifically throughout the last few years is that, financial education through social media and whatnot has so damn accelerated. When we launched T-Bills on the app, Q1 last year. And when we launched it, we jumped on with reporters to talk about it. Like we had, really deep financial markets reporters that we had to explain how does a T-bill work again? Because it was so, these are like professionals in the space. And just because it was so, just like irrelevant for such a long time, within the public community, you suddenly like, it took a week and you had people talking about building ladders for the bonds, basically, meaning, you build like a bond ladder, so you kind of get cash flow through a certain period of time as they reach maturity and like different maturity lengths and stuff like that. And like that, it went from like people borderline have not really thought about or heard about or understood how these things work to people talking deep strategies within like a week. And I think that type of like rapid education in these like bite-sized formats is just what exists today, which didn't really exist 20 years ago. And so that generation didn't go through that. And I think that just makes people also much more comfortable and confident that, yeah, they could potentially run part of that portfolio themselves.
You guys recently launched options. And one of the interesting parts is that you're going to give 50% of the options revenue back to the user. Obviously, this gets into payment for order flow, a lot of different platforms, kind of how they think about their relationship to the user versus maybe other constituents that they work with. Why are you giving 50% of your revenue back to the user? And like, how exactly does that work?
Yeah, so you might remember that in 2021, we actually stopped participating in payment for order flow on the equities trading side, like on the regular stock trading. And we did that for a few reasons. Number one, it leads to better price execution for the user. It just creates, just like more transparency for people to know that like if you execute a trade in public, public will do its best to make sure it executes at the best price. And then the other piece of it is that payment for order flow generally, it incentivizes a company like us for that, we want people suddenly to trade a lot, et cetera, et cetera. And it kind of creates this like misaligned incentives between the brokerage and the customer. And, that impacts things like how you think about product development and what features you do and, things like lifecycle marketing in the app and all that kind of stuff. And and so like just thinking of that, like your business model impacts your incentives, which impacts how you design things. And when we launched options, which was one of the most requested features we had kind of ever, right? The thing was we looked at, again, those market structures and we were like, okay, in the market structures in options, you actually cannot get rid of the market maker as long as you don't necessarily become one yourself, which is obviously quite a process to do that. But you cannot get rid of them, right? And so payment for order flow, because market makers are so baked into that market structure, you can't really get rid of it. Now we were like, so what is a more transparent way to align our incentives with the ones of our users and kind of continue that thinking throughout, also in the also in the options markets. And that was a sense of like, okay, what if we actually give part of the payment for order flow revenue that you make on options trading and give it back to the user, because it creates this transparency for them to really understand exactly how much money do we make on each trade that you're making, because you're making the same amount, exactly how much we're making. So it creates some transparency. Therefore, understanding like and having clarity of like what our incentives are as a business in that moment, and in options trading, we make money on that. And so therefore it's like, yeah, someone who trades more, we will make more money on that. But it's better for the user to understand and know that, and have clarity there and transparency than not. And then generally speaking, that just adds a little bit transparency, just like the market structures as a whole, right? The stuff is super complex. I literally just, scratched the surface here. Like we could talk about the whole podcast about those market structures there. But it is, something that has been fairly intransparent that is important, I think, for people to understand. So they understand incentives, so they understand, how things work. And also if these things change in the future, that they know what that means for, their assets for the future as well.
When you think about building the business, it's a big business today, right? I don't know how many employees, revenue, like whatever numbers you could share that just kind of give people a sense of like how big this business is. And then maybe we can get into like the actual company building operational stuff that you've done to get here.
Yeah. So we're 3 million users. And again, we launched a little over 4 years ago. So this is now our 5th year in market officially. And obviously, how you can think about it is, what you've seen throughout 20 and 21 was a lot of user growth. A lot of people went into the markets, but also the behavior was, I would say, in most cases, a little bit more speculative. And what you've seen throughout the last, 2 years now, roughly, right, or soon to be 2 years, is that behavior has changed to be, call it, less speculative more fundamentals driven, et cetera, which also means people are actually moving way higher dollar amounts into the markets. And so like we've seen, for example, our like first deposit of people that sign up and deposit for the first time into the app that 20x'd throughout the last, call it 18, 20 months. And there you see that just like the behavior has drastically changed, of those people and so on. And that's how you can kind of think about it. And so, in these markets, you see maybe less people creating new accounts, but the people who are coming in are way more, kind of like serious about, their investing as they get started.
Now, as you've built the business, 4 years, millions of users, you've had to hire very quickly. You've probably moved offices multiple times. Like there's all these things that go into hyper growth. How did you keep the culture an area where people wanted to come work here? The people who were working there didn't want to leave?
Yeah. First, I think tenure is a wrong thing to look at, to be quite honest, because, we have the board, we have Jessica Neal, who was the chief tenure officer at Netflix. And, I personally love the Netflix, employee handbook, for example. And just like this whole notion of a company is a sports team, not a family. And, if you take the sports team analogy, right, the best players stay. And it's completely fine that you potentially have players on the team who, will do a phenomenal job and will really fit into what the company is for a year or 2 or 3, and then they might not. And that is completely okay. And so I think tenure is generally the wrong thing to look at because it's not necessarily a sign of success, right? There may be certain people that shouldn't work with you. What we rather look at is the ratio between voluntary and involuntary churn of your employees. So how many people that you want to be in your team are actually leaving your team versus how much are you in control of who's at the team, aka the people that you let go. And generally speaking, I think, that if you are more in control of who's on the team, aka the ratio of people that you let go is actually higher than the people who are quitting themselves, that I think means you have, generally speaking, a more healthy culture, because culture is really just how you work in order to make the company successful. And that's, versus like ping pong tables and parties and whatnot. And so I think that's how we rather look at that, right? So sports team and the family.
How do you go about evaluating talent, both as they're coming in to work at the business, and then also whether they are one of the top performers, or you may need to part with them and go find someone else for the role?
This episode is brought to you by Freck. Historically, the wealthy had a hidden secret in investing. They would spend a lot of money and use very big teams to conduct tax loss harvesting. Tax loss harvesting is the timely selling of securities at a loss to offset the amount of capital gains tax owed from selling the profitable assets later. But now Freck is bringing this incredible advantage to any investor. They'll literally lower your tax bill, regardless of how much money you have. They use state-of-the-art technology through a product called direct indexing to allow investors to invest in the S&P 500 while getting all the benefits of tax loss harvesting without the big bill. If you want to learn more, go check them out at freck.com. That's FREC.com. I'm a big fan of the product, and I even became an investor in the business. Freck.com. Go check them out today.
Yeah, and I think our view on that developed over time. Like we had this moment where we raised a ton of money in 2021. We hired a bunch of people. Team grew really damn quickly. And we reached this time where we were like, okay, now let's bring the experienced manager in who comes from a little bit of a bigger tech firm, et cetera, et cetera. And then suddenly what turned out, you had also people on the team who maybe, rather have one-on-ones with people than, actually be deep in the work. And what we've really, I think, learned for ourselves, which kind of became a little principle at Public now for management, is like at Public, every manager is also an IC. And you must have a love and an obsession for the craft. And that falls into, my co-founder Yannick is really deep in Figma files with, the direct IC designers, right? Like literally yesterday, I was really deep in copy docs of some life cycle emails that we're sending out and stuff like that. And I think, everyone needs to be really deep in the work and must have this love and obsession of the craft. Because I think that's really what everything kind of comes back down to. And I think there's too many of these management mindsets of which leads to people wanting to build armies and whatnot, where they think their worth and the value to the company increases with, the more budget they oversee, the more people they oversee and whatnot, versus the actual value they drive for the company. And hiring should be a last resort, not the first option. It should not be a strategic move of like, we want to do this, let's hire someone to do that, right? Hiring should be the last resort of like, we cannot figure out a different way to do this, therefore we now need to hire. And, and so on. So like, I think there's really the sense of that the biggest thing we care about is people that are completely willing to get their hands dirty and, think that is like, and that's what they get their joy out of, right? And so on. And I think that culture just needs to be there at all times. And I would say we had a small moment where we lost that, to be honest. And I think throughout the last 12 to 18 months, we've been trying to aggressively, make sure that that's truly what every single person hears.
How do you think about fundraising? You've fundraised in really good times, and you've also, I'm sure, evaluated doing it in bad times as well. How has that changed? And maybe what are some of the lessons that you've learned there?
Always raise more money than you think you need, because you don't know what's going to happen. That's for sure. Like when we raised, like the last time we raised was in 2021, it was February 2021. So we're still running on that money today. And at that point in time, we raised $220 million, which was nuts. Just, let's be honest, effing bonkers, right? We were 40 people, 45 people when we did that, And also at the time, we had very little revenue. Like we were like in the middle of GameStop, there was a lot of momentum behind us, right? But we were 18 or less than like 15 months in market, like super young product, super small team. And we raised a ton of money on that. And at the time, like I remember the first term sheet was for $100 million. And then we just like talked and whatnot. We were like, should we make it 200? Because it seems like we can. And to be honest, it was one of the best decisions we've done. Because our future would have looked very different if we would have raised half of that, right? And in that moment, that money was just ridiculous. 100 was just ridiculous. So 200 was just stupid, And but it was one of the best decisions, to be honest, because we're still running on that money today. And it was, like we could have predicted the future of how the market's going to contract and whatnot. I think generally speaking, what's happening right now is very healthy. I think what happens in the zero interest rates, environments is that, Yannick and I had this term where we talked about of like the Zerpreneur. So someone who, in a ZERP environment becomes an entrepreneur because it's easy. And that is all washed out, which also means you just have more talent density, And I think in these markets, people get focused again on like, what are we doing here? We're here to try to build a really healthy, good business that ends up making money. That is the number one purpose of a business, not all the other distracting things around it. And I think, in those ZERP markets, I think we also all, like as an industry as a whole and everyone got very distracted to suddenly care about a bunch of things that maybe we shouldn't have cared about as much. And, that affects company cultures, that affects, how you think about money, that affects how people build teams and whatnot. And, I honestly, I entered the workforce in like before 2008, right? And I moved to the US in 2008. And then suddenly, I was, the person in the job where around me everyone got fired. And then you had 10 years plus where a bunch of people entered the job market. They did not have that experience. And so I think having this moment right now is very, very healthy for people's perceptions of what's the purpose of the business truly, what unit economics actually should look like, et cetera, et cetera. And, that obviously means that valuations contract in the moment in time, but they will expand as well at some point again. Maybe not as crazy as 2021 multiples, but, prices go up, prices go down. And, we raised a lot of money in 2021 at a very healthy valuation at a time, and we will raise money again at some point likely. And when we do, we'll see what the valuation is at that point. And that is totally okay, right? If anyone in the stock market knows everything goes up and down, and it's better to be realistic on that than, try to get too crazy in your head.
You said that the business would be very different today if you had raised half or less than what you did raise. Mm-hmm. What would be different? Like where do you think the business would be?
I think it's two things, right? I think first off, there's obviously company strategy would have been slightly different in terms of how you deploy the capital, because if you have less, you deploy likely also a little less. So that's, I think, one thing. at least in the call it like the 2021 years. Now, though, on the other end, it would have still meant we would have likely needed to raise money by now. That would have been my assumption. And, that meant we would have needed to raise money likely exactly at the time where valuations would be crazy compressed. And, and also, and then in that moment, I think, you still have a business that runs the way it was running in 2021, early 2022, and how startups that ran on venture capital were operated at the time, aka, likely less efficient than people operate right now. And it's definitely true for us. Like, we're now running way more efficient than we have done in those years, right? And then you would have need to raise money at a time where, everyone's minds already adjusted to the new market conditions, but you didn't actually have time for your business to adjust perfectly to that yet, or to at least show the track record that you have, and then you have to raise time and money at a time where the valuations contract. So that combination, I think, is deadly, right? The combination of looking at how you run your business still being in the old world, the new world having adjusted, and valuations contracted, I think that kills companies. And so very, very lucky that we were in that position.
How do you think about regulation? Obviously, you are in a highly regulated industry. There seems to be a lot of maybe gray area questions, concerns at the things that are like the furthest out, crypto, maybe even royalties, like these areas that are not really the mainstream financial assets. Have a lot more regulatory questions than obviously a public stock on, the New York Stock Exchange. So how do you think about, navigating that while also trying to innovate?
Generally speaking, I think there's a lot of regulation that's still behind, right? If you think of, things that, that you have to be accredited and how you can become accredited in order to invest in, for example, private companies, and things like that. I think that is still outdated and needs to change, to be quite honest. On the other hand, you had some innovation, right? So, it's now 5 years ago, Reg A Plus was introduced, which is basically an ability to turn any type of asset into a SEC registered tradable security. And that has been used to, turn things like a piece of art or, royalties, and make that an investable asset class that you can buy and sell shares in, right? So we acquired a company a few years ago called Otis, which basically used Reg A Plus to do that, and we integrated that into the app, where, now on public, there is even, you can put, you can buy a share in a Banksy, or you can buy a share in the Shrek music royalties. So anyone who watches, a Shrek movie, you suddenly actually make cash flow on that, right? And actually, the yield on that when we IPO'd that was higher than most bonds out there and stuff. And it's completely uncorrelated to the financial markets, because it's based on content consumption, not the financial markets. And so, and then the ability to add that to your portfolio, et cetera, et cetera. And so, like Reg A Plus, for example, I think was a good innovation that actually came out of the regulatory environment to enable these types of things. It's still, expensive to do it, et cetera, like as a company. But generally, I think we had some innovation that's good as well. The Bitcoin ETF is another one, right? Good that happened. But I think there's still a lot that needs to happen. Generally speaking, like, our name is obviously public. And so we often think about it this way of like, it's on us to constitute, it's on us to define what constitutes a public market. And, things like making music royalties actually tradable and accessible to anyone to participate in that asset class, is obviously, kind of cool and a good innovation, I would say. And I think you will see much more of that, to have this like securitization of everything happen. But it will take still likely a decade plus for, that to trickle into more asset classes, or into all asset classes.
My last question for you is, it is your job to understand where you've been, where you are today, but also where this entire industry is going. What are maybe one or two things that you think are going to happen in the future that either people aren't thinking enough about, or maybe things that everyone believes will happen, and you're like, I'm not so convinced that that's actually going to be where the world goes?
First, I think interest rates are going to stay higher longer than people expect right now. That's my little macro take here. But yeah, I mean, generally speaking, again, like number one, it's the securitization of everything. I think you're going to see more liquid markets around private securities happen at some point. I know Carter just had to now close it down. I think that was actually bad for the industry that they were kind of forced to do that, despite the maybe questionable tactics that potentially were unveiled there. But nevertheless, I think it was actually bad for, the private markets that Carter suddenly closed down their efforts to try to build, like an exchange for private securities. I think that was kind of a stupid outcome for everyone, to be honest. But I think that, those are, I think, some of the, more, exciting things. The other one, sorry to be that, but like AI, I think is going to have a massive impact, right? Like we launched Alpha on the app, which is like a research assistant, which we basically, which is just like basically like an LLM that we trained with earnings call data and analyst reports and, just like historical fundamental data, et cetera, et cetera. And so now you can just swipe down on any stock and ask any question about the stock. And it's phenomenal how well that thing works. And I think the next step there is obviously for those tools to be personalized to our portfolios. Doesn't necessarily mean that an AI will like trade for you, or if that's good or bad, but just the sense of that, what's like the impact that AI can have on just like portfolio management and giving you insights quickly around your portfolio, I think is going to be awesome to see.
Where can we send people to find you online, or if they want to check out Public, get an account, where can we send them?
Yeah, go to public.com to sign up. And obviously you can find me on Twitter at Leif, Leif Thunder. There's a whole other story to that handle. We can talk about that next time.
All right. Sounds good. We'll definitely do this again in the future.
Cool. Awesome. Thanks for having me.